You tap your phone against a contactless terminal, and a digital confirmation instantly lights up the screen. The purchase is complete. But right behind that purchase, a second, quieter transaction takes place. The app takes the remaining 54 cents from your coffee order, rounds it up to the nearest dollar, and sweeps it into a separate savings bucket. Almost immediately, a notification pops up to congratulate you. A small animation plays, signaling that you've done something responsible today. This automated loop replaces the friction of traditional budgeting with a seamless, engineered sense of accomplishment. You are saving money without ever having to think about it. Today, you will find this feature built into the apps of nimble digital startups and legacy Wall Street behemoths alike. These institutions aggressively market microsavings as a tool for consumer wellness. They present themselves as partners actively helping you build a financial cushion, 1 cent at a time. Yet, building and maintaining the infrastructure to process millions of microtransactions is expensive. It requires vast data centers and continuous technological investment to capture what amounts to pocket change. The math only makes sense when you look at the bank's balance sheet. This consumer perk is a highly sophisticated funding mechanism designed to solve the banking industry's most pressing structural problem. To see how effectively this mechanism works, look at Mysuru, a Tier 2 city in India, where fintech companies are bringing unbanked populations into the formal financial system. Rather than asking users to save raw cash, platforms like the Jar app digitize an existing cultural habit. They automatically convert spare change into fractional amounts of gold. By linking these deductions to the local digital payments network, the app eliminates the friction of deciding to save. The money moves before the user can spend it elsewhere. The developers then layer in digital rewards like spin-the-wheel games and daily usage streaks to ensure users keep the automated deductions turned on. This correlation matrix shows the exact results of that gamification. You can see a strong positive correlation measured at 0.641, directly linking engagement with digital rewards to the frequency of microsavings deposits. The streaks and rewards hijack the brain's dopamine receptors. They keep the user focused on maintaining the habit, distracting them from the fact that their actual monetary return is almost zero. Back in the United States, the Federal Reserve's recent interest rate cycles have reshaped the operating environment for every major financial institution. When rates stay high, wealthy individuals and corporations notice. They move their massive cash reserves out of standard checking accounts and into treasury bills, money market funds, or high-yield certificates of deposit. This sudden capital flight drains the capital banks need to operate. As institutions lose their funding base, they face rapid liquidity crises that can force them to close their doors entirely. To survive, banks desperately need core deposits. These are the stable, low-cost checking and savings accounts that sit quietly on the balance sheet, largely immune to rate chasing. A single user rounding up 50 cents is insignificant, but pooling millions of gamified accounts generates billions of dollars in highly stable, zero-interest funding. Micro-savings tools are a structural honey trap. They attract the cheapest possible capital precisely when funding costs everywhere else are soaring. This creates a massive net interest margin. The bank pays a fraction of a percent on your spare change, then lends that same money out for loans at 6, 7, or 8%. Because the deposit cost is effectively zero, that spread becomes pure profit. It multiplies across millions of users, generating vast returns from money users barely notice is gone. The profit from lending is only the first phase. The secondary institutional benefit is a dramatic drop in customer churn. Industry data reveals that customers who actively engage with personalized budgeting and savings tools are 2.7 times more likely to remain long-term clients compared to those who only use basic checking. Your spare change is locking you into the bank's ecosystem. The gamified streaks and automated transfers make the platform sticky, securing a permanent, highly profitable relationship for the institution. For individuals with little to no savings, these automated tools do provide genuine utility. They lower the psychological barrier to entry, turning the intimidating task of saving into a passive background process. Over a few months, those roundups build a modest cushion. That small pool of funds can cover a surprise medical bill or a delayed paycheck, keeping an emergency from spiraling into high-interest debt. But a buffer is not an investment strategy. The yields on these microaccounts are so low that the purchasing power of your spare change steadily erodes under the weight of inflation. When you rely entirely on a platform's automated nudges to manage your money, you bypass the friction required to make active, deliberate decisions about wealth generation. These apps function as financial training wheels. They are an excellent way to start the habit, but they do not possess the mechanical power to drive you to financial independence. By wrapping a lucrative corporate funding strategy inside a bright, gamified interface, the banking industry successfully outsourced its liquidity problem to the everyday consumer. While you get a digital high five for saving 72 cents, the institution pools that money into a solid block of capital to finance high-yield investments. The next time an app congratulates you for rounding up your lunch order, consider who is actually benefiting from the transaction. Your spare change is doing exactly what it was engineered to do. It is serving as the cheap, sticky fuel that powers the profitability of the modern banking machine.